Well, as we were saying earlier on in the show, one of the threats to inflation staying within the central bank's target band of between 3 and 6% and growth where unemployment is still rife has been wage settlements at above current inflation rates. Just yesterday, thousands of South African public service workers seeking higher wages walked off the job, with union leaders saying the strike could set the stage for nearly 1 million workers downing tools next week. To unpack the situation that's unfolding there, Christopher Malikane, head of policy at COSATU, and Taye Alemu Mengistae, a Senior Economist at the World Bank, join me now at the desk. Thank you both for joining us this afternoon. Chris, I'm going to start off with you because the Public Servants Association, which represents 210,000 employees across various different government departments, have embarked on the strike aiming to pressurize government to improve a pay offer. So let's get your view on all that's unfolding there.
I think that the fundamental problem in South Africa is that of worsening income distribution despite democracy. So, and secondly, the fact that in South Africa we don't have a comprehensive social security system. So the people who are unemployed, those who cannot access the little social security that is there, depend entirely on those that are employed. And then the third point is the fact that when you look at the wage increases that the workers are demanding, are actually trying to recover the purchasing power that they had in 2008. On top of that, given the fact that the crisis has created unemployment, the workers are trying to raise wages so that they can sustain those that are currently unemployed.
Well, that is the argument on the one hand. The other argument is that by increasing wages at above inflation rates, we are lessening the bit of pie that is available for the rest of, or the unemployed South Africa, if we can call it that. What do you see the spelling for the employment picture moving forward?
Well, there's no link, in my view. The link between the wages and employment in South Africa is not as strong as the link between public infrastructure spending and employment. My view is that if government over the past 16 years had embarked on an aggressive public infrastructure program, economic infrastructure and social infrastructure, rolling out clinics, hospitals and so forth, would not be having the problems that we have today.
For now, we've got negotiations underway. When it comes to the impact of the economy, we've heard that the strike could set the stage for nearly 1 million workers downing tools next week. I know that it's still very hard to evaluate the full impact of the union's countrywide industrial action this early on. But what kind of cost is starting to be priced in here in terms of impact on economic growth?
Well, in my view, I think that the public sector workers do not have that much of an impact on economic growth, but the impact is likely to be on the delivery of social services like healthcare, education and so forth. It is the private sector unions that are actually having a bigger impact. You saw with the strike with SATAO, which is relatively a small union in COSATU, but it was able to hold the economy at at standstill. So public sector unions are not as powerful in terms of affecting the economy. That is why they are more militant, because they know that they can't put the economy at standstill to pressure the other side.
Taye, with that verdict still out in terms of just what impact this is set to have on the economy, what does a public service strike like this do amidst a globally uncertain growth picture right now to foreign investor confidence, in your opinion?
Well, I would rather talk in the context of the investment climate assessment report that was released yesterday by the Department of Trade and Industry. And in that report, we list a number of factors that influence the decision of foreign investors whether or not they would come to South Africa. Certainly, uncertainty is not good for investment, foreign or domestic, and to the extent any strike can feed into that uncertainty. It is not.
But more directly, we've got the issue of labor costs and high labor
but we
costs.
don't know. I don't want to comment on this particular strike. I don't know the context, and it certainly is not part of our report. So I'm not competent enough on that. I can only say that the sooner this is resolved, the better, because it means less uncertainty without taking sides on the dispute. But overall, the key factor right now that is really deterring investment is, or rather deterring the competitiveness of South African industry is productivity, really. And our report is talking more about productivity. The basic message of the report is that South Africa has a good business environment on balance that compares favorably with its peer group. Countries like China, Malaysia, and Thailand in the east, and also Brazil, Argentina, and Chile in Latin America. These are its peer groups. Compared to these groups, South Africa has a better or a comparable business environment. And that's one message. But the second message is that in spite of that, it is not attracting as much FDI as it should to solve its unemployment problem and so on. And it's not exporting as well as those countries because aggregate manufacturing productivity is low.
So what lessons should we be taking and bringing back home from peers in our group specifically that we need to start getting and, you know, tackling fast?
The basic lesson is that one should increase the efficiency of domestic industry, the allocative, what we call in the report the allocative efficiency, and by that we mean the distribution of market share across firms. And it turns out that in South Africa, industry is so much concentrated that the share of low productivity firms is high in the market share, while that of high productivity firms is low because of high concentration, and there is a need to devise an activist competition policies that addresses this problem so that it would be easier for new investors to come in and for the share of the market share of high productivity firms to go up. That's the basic lesson.
Well, Chris, you know, we've got a catch-22 here, where on the one hand we've got the downing of tools, meaning the slowing down possibly in the pace of growth, and not only pertaining to this, but when, you know, where we've seen other sectors engage in strike action as well, but where on the other hand setting higher wages may see even less FDI coming its way, with the World Bank fingering South Africa's labor costs as a key deterrent to investment. The question now, what do you see government coming to the table with come next week?
I think government is going to stick by its guns because remember that they are constrained by the inflation target, that they should not be seen by the Reserve Bank as not supporting the inflation target. But at the same time, government is put under pressure to make concessions on other benefits that workers can get, rather than simply the inflation increase. But there are other benefits, conditions of employment, and so forth.
I need to say that we refer to high unit labor costs there, and that basically means it's the figure we get when we divide wages, the wage bill that companies pay by their output. And that is relatively high in South Africa, and that works against exports and FDI and so on. But we're not saying that the primary problem in South Africa is labor costs. That's not. We're not. So wages are one side, productivity is the other. At the moment, productivity is probably the key issue.